I've seen that Australian Small Scale Offers Board. How does that sort of fit into the model?
Okay, ASOB, the Australian Small Scale Offerings Board. ASOB is a version of a public market. You have to be a publicly listed company, a publicly registered company instead of a proprietary limited company, private company. You have to use an ASOB approved corporate advisor who will structure your offer. And the way they normally structure the offer is in 2 or 3 lumps. So they'll sell the first $200,000 for 3 cents a share, the next $300,000 for 4 cents a share, and the next $300,000 for 7 cents a share. Right? And so you pay a fee to the ASOB, you pay a fee to the corporate advisor. ASOB is then just a platform, it's a marketplace, it's a registered marketplace, and your corporate advisor helps you promote the opportunity, find investors, and recruit the investors. It works quite well. I really like the CEO, and I particularly like that at the beginning of this year, he very creatively said they are the largest crowdfunding for equity platform in the world. Because they are, if you want to look at it that way. It's a very creative interpretation. It's good marketing. But they are a legitimate channel. They're well worth considering if your business fits their model. And if you've got the $20,000, $25,000 it takes to pay the fees to get into the system. And there's a success fee with it. So out of the money that you raised, I think it's 6.5%, something like that, is paid to, in some combination, to the advisor and to ASOB. So it's not a bad way to go, but it's just a different sort of channel. You have to have all the formal things. You have to have a formal offering document, not a prospectus, which you would have to have for the ASX, for a public market. It does also offer a secondary market. That's the other important thing about ASOB. Once you've got shareholders, it will facilitate the opportunity for them to sell their shares to some other person. So it's sort of like the public market, not quite. Is that clear?
Yeah, no, that's good.
So can you talk a little bit about one of your better deals, like the one that made you more money or the one that you feel very good about, and talk also about the one that you feel bad about, and I guess was fine on that.
Okay, so the question is, can I offer some lessons from a good deal and a bad deal? So the best deal I've done in Australia, because I actually started my investing when I was living in Silicon Valley. The best deal I've done in Australia was actually where I co-founded a company with a contestant in the Melbourne University Entrepreneurship run by Melbourne Business School in the very first year of the program. And we spent 12 months together getting the business going, and I invested in the business, and then I stepped aside from the day-to-day, but stayed part of the team. I was the only external investor in the business. There was just the two of us, so we never formed a board, but I was basically the board. And 10 years later, I exited that business for 34 times my investment. So if you do IRRs, maybe it doesn't sound quite so great, but early stage investors rarely do IRRs because time cost of money is an institutional way of thinking. It has value, but the truth is if you're going to worry about it, you shouldn't do this kind of investing. So generally early stage investors measure their returns as cash on cash. So that was pretty good. That was actually where the entrepreneur bought me out. The business was doing really well. He wanted to take it in a new direction. It was going to be risky, and he didn't want to risk me losing everything. So we did a deal. How did we do that deal? Because we had a very good relationship. And he wasn't quite sure how to do it, so I led him through it. But I basically said, we're going to sit down, we're going to look at the facts, and we're going to look at our expectations, and we're going to come up with a number. And when we come up with that number that we both agree on, you're going to feel like it's a little bit too much, and I'm going to feel like it's a little bit too little. And that's how we know we've got the right number. That's fair, right? If I think I'm getting a great number, he's going to feel horrible. If he thinks he's giving me a great number, I'm going to feel like I'm getting cheated. So we did that process. I took a little bit of work, the tax returns, financial stuff, but we did that. And just before we shook hands and agreed, we were literally about to shake hands. So when I knew him, he was single. I went to his bachelor party. I saw his kids get born. Right? It was 10 years. It was a long time. I said to him, can you go home to Jules? Can you go home to your wife and say that you're happy with the deal we've done today. Because that's, again, depends who you are, but I believe people are more important than money. So I wanted him to test his total environment. If he goes home and has hassles with his wife because we should have had the deal $10,000 one way or the other, I would actually have moved the deal. But he said no. He said, I feel comfortable that I can do this. She's not going to be upset. She knows you. So we did the deal. So that was a really good deal. We grew the business substantially over those years, and we parted friends and with money in our pockets. And I'm supposed to catch up with him next week or the week after to find out how things are going. So that was a really good deal. A really horrible deal that actually had absolutely just about everything wrong in it was one of the first deals that we did after I formed the Angel Group. We invested in an entrepreneur in Adelaide. There were pre-existing investors from New Zealand. Neither the entrepreneur nor the investors had any experience in early stage business. So they had already trained each other over about 18 months in some very bad habits, which was very hard for us to break. And eventually, to be honest, we didn't really break. One of the worst of them was what I call drip feed funding. So the investors gave him $100,000. Of course, he ran out of money because it's not enough to get anything done. Plus, he was paying himself and his staff quite well. So he asked for more money, so they gave him more money. They started getting a bit nervous, so they stopped investing the money and started lending the money. So by the time we came along and saw a fantastic exit opportunity waiting to happen that they hadn't seen, we said, we'll invest in this exit. We don't want to build the business, we want to sell the business, and we know how to do it. They'd invested about $1.5 million. We forced the valuation of their business down because their business was in a bad situation, so that after we invested, the business was worth $1 million. So that creates tension because investors don't like having the value taken from them. What we didn't understand is that the entrepreneur was also a bit of a con artist. So what he said was there wasn't actually there. It took us a while to find that out. But we said we'd invest in the exit. Within 3 months of us closing the investment, we had a deal from the largest company in the world in their sector, right, on a company that was worth $1 million after we invested. 3 months later, we had a term sheet for a $27 million exit. On the last day of due diligence, the company came back and said they weren't going to do the deal. And the reasons they gave were very concerning, and they related to the entrepreneur and to the intellectual property. And we took a close look at it, and we actually managed to get another term sheet from the number 2 company for just a little bit less. I think it was about $25 million. Same cycle, did the due diligence, impressed, not so impressed, not going to do the deal. Same reasons. We went to the other investors and we said, this is a problem. The entrepreneur is a problem, intellectual property is a problem. We need to shut this business down, dead stop, reassess what we've got and figure out where we can go. The other investors wouldn't hear it. They said, you don't know what you're doing. I was on the board, it was very unpleasant. So what I did is I actually established a strategy with my other angel investors. I said, I'm going to get all the anger in the board focused on me by telling them all the truths they don't want to hear. And then I'm going to get off the board. One of you is going to replace me, and you're going to be really nice. So bad cop, good cop. And see if we can somehow move this business somewhere where we can do something with it. That part of it sort of worked, but we weren't able to move it. They ran it into the ground. The entrepreneur got what he wanted. He got out of an orphan divorce. He got his green card so he could relocate to San Francisco. He then said, well, you can't pay me, whatever it was, $120,000 a year anymore. So I'm not going to work in the business anymore. I'm not going to get another job. But trust me, I will keep looking for a way to make money out of the intellectual property, even though the core patent out of the family had been overturned and rejected. So just the other day, one of my fellow investors from Melbourne wrote to all the investors saying, this company is dead. It's been dead now for a couple of years. We should just shut it down, take the loss and move on. But we know that those other investors who were there before us don't understand that, don't want to do that. They're still hanging on by the fingernails, hoping, praying that somehow magically something will happen. So there was a lot in that deal that was not good. Bad investors, bad entrepreneur, bad experience. But to be honest, it was a great learning experience for everybody. I didn't think I'd ever make a mistake like that again. Most of us have paid very expensively to learn how to be good investors by losing money in deals like that. I didn't lose a lot of money in that deal, so I'm kind of relaxed, but I didn't think I'd make that mistake again. But you do.
Jordan, you mentioned that a lot of we, and there are lots of people behind the deal. So how do you, who are you, and do you specialize? There's like set of people. How organization works inside?
Oh, okay. So how does Melbourne Angels work?
Yeah, or how you invest, is it?
Okay.
How you decide to invest?
Melbourne Angels is a group of 40 individuals. We all make an individual investment decision on every deal, typically investing 25 to 50K each per deal. So to make $500,000 round, we've got to get 10 or more people together. Sometimes someone wants to put in more because they're really excited. We have two ways of investing. About half of the deals we've done, we invest using a unit trust. So a single special purpose unit trust just for that investment. We're a brand new special purpose corporate trustee to manage it. And that's good because it gives the company a single shareholder that represents all of us. And it creates a structure for the company to know who to deal with and for us to fashion our communications and structure. So it works quite well. We did that in one company which it did end up listing, and so we had to dissolve the trust because once it's listed, the trust has no real function. The other way we invest is we all invest on the same terms, but just as individuals side by side. Just each one becomes a shareholder. And the truth is most people invest in a self-managed super fund. So they're actually not investing as individuals, they're investing in the Green Family Trust. I don't actually do that, I'm single, so I invest in that. Okay. Yep.
Yes, there's a lot of mythology around the characteristics of entrepreneurs. There's a lot of research being done on that topic as well. I'm just curious, can you describe the profile of the people that you have in your portfolio? What do you look for?
So is the question, what are the characteristics of an entrepreneur that we would like to see?
Yes.
Yes? So we'd like to see someone who's honest, someone who's got a lot of passion, because there's going to be a lot of hard times to get through and you need something to carry you through it. Someone who's hopefully smart, at least in a way that's relevant to the business. And someone who is open to hearing what we have to say. Other things become secondary. So do they have to be a good leader? Not necessarily, as long as they're willing to let somebody else lead if they're not a good leader. So a conversation we'll often have with someone we're seriously thinking about investing in is, how would you feel if 2 years from now we have to hire a CEO who's going to run the business and you're not going to be the CEO? That's not because we intend to do it, but it's a very real possibility, and how they deal with that question tells you a lot about a person. It goes back to what I said earlier about control freaks. They're going to suddenly realise, confronted with that reality, and we do try and do it so that they have to deal with it and not just pay lip service to a response. So there's a technique in doing due diligence on entrepreneurs, which, by the way, is a mutual technique. It works for the entrepreneur on the angel investors. So a couple of years ago, I was speaking at an international angel conference, and we were sitting around afterwards, just having a drink, chatting, and saying, how do you figure out if the entrepreneur is someone you want to back? How do you do it? Because usually you don't know them over a long period of time, which is the best way. And one guy came up with a really good answer that I've since put into practice, and I find a very successful answer. And like I said, it works equally for the entrepreneur. When you're down to the point where you really want to know, have a meeting with the entrepreneur. But don't have a 1 hour meeting, because we all rehearse and we know exactly what we're going to say in a 1 hour meeting. Don't have a 2 hour meeting, because a 2 hour meeting is still just enough to cope with. It's all the secondary answers, secondary questions, speak a little bit slower. You have a 3 hour meeting. Right? Take them to lunch. Invite the entrepreneur and their partner. Go to dinner. Spend time. Talk about all sorts of stuff, not just the business. That is probably one of the best and oldest tricks in the book for figuring out whether or not this is a person you want to spend even more time with in the future. Right? Delve into who they are. Talk about all the forbidden topics. Talk about politics, talk about religion, talk about sexism, talk about sexuality, talk about whatever it is. Get to know the person. So in our group, we often invite companies who are not yet ready to raise money to pitch to the group, so we get to see a little bit of who they are and what they think they're going to do. And then come back in 6 or 12 or 18 months and keep us informed along the way a little bit. So when you come back to raise the money, we saw you, you said you were going to go on this journey. Then we see you again, and you tell us what happened on that journey. What adversity did the world throw at you and how did you respond to it? That tells us a lot about who you are and how you've grown and what you've learned, and therefore how you're likely to behave in the future. So there are all these different ways, but fundamentally it's very hard to judge people, so the only real way to be sure that you're judging people is to spend time with them. There are groups I know who use psychological profiling and other tools. They can all be useful, but they're really only supplements to the core, which is spend time, get a good gut feel that there's a relationship there. And like I said, that technique works both ways. By the time you spend, by the time that entrepreneur has sat with you for 3 hours, he knows whether he thinks he wants you in his business. Did you just have some fancy words that sounded good for the first 1 hour conversation? And when you dig deeper, you actually don't know anything about it? Or is there actually a lot more there that he can get access to and that he can learn from and benefit from? So it works both ways.
So, John, maybe we'll just take one more question and then we can anyway continue
Okay.
with the drinks outside.
Can you talk more about clean tech VC in Australia and the process of getting grant for commercialisation of the product?
Okay, so the question is, talk more about clean tech funding, in particular venture capital funding for clean tech in Australia, and getting grant funding for a clean tech project.
Okay.
So as far as clean tech venture capital goes, there are only 2 options. There's a firm here in Melbourne called Clean Tech Ventures. They are the only specialist clean tech venture capital firm in Australia. They are actually one of the few firms I would say is a good firm. Unfortunately, they're all but out of money. I think they have maybe $2 million to invest. So, as good as they are, they're not an option. But they've done really well. I hope that they'll work through their portfolio, get some good exits, and be able to raise another fund, because I actually think they're a good team. As it turns out, purely by coincidence, one of the founders of that team is an engineer who I hired into his very first job out of university when I ran an engineering services company here in Melbourne. But it's pure coincidence. He also, by the way, is a graduate of the Melbourne Business School who came to do his MBA some years after I did, and I gave a talk at orientation and saw him in the audience. So I'm not saying the firm is good because of those connections, but it is a small world. The other firm is, so they're Clean Tech Ventures, the other firm is Southern Cross Ventures, which is a general purpose VC firm, but they won a competitive bid with the government to get management of a new clean tech fund. One of the ways they did that is they found matching funding from Singapore. So they have a $200 million clean tech fund that they just started investing from about 8 months ago. So most of the money is still available. They have offices in Melbourne, Sydney, Brisbane and Silicon Valley. But their primary investment partner for the Clean Tech Fund is based here in Melbourne. And he came to them from Clean Tech Ventures. And when that fund didn't go to Clean Tech Ventures, he needed a job, so it was obvious he was the right person in Australia to do that job. Because he wasn't one of the founders of Clean Tech Ventures, so he could move. Founders in a VC firm can't really move. Southern Cross Ventures, as far as VC goes, are the primary opportunity for VC funding of clean tech in Australia. Assuming that it's a suitable opportunity for venture funding. The problem with most clean tech projects is they're actually infrastructure projects, and as a result, venture capitalists don't invest in them because you need tens or hundreds of millions of dollars. Those get backed by private equity firms and other funds. The federal government has a total package, including that clean tech venture fund, of $10.2 billion for clean tech, and about somewhere between 7 and 8 billion of that is in various pockets to fund infrastructure projects.